Hello and welcome. I'm pleased to be joined today by Norbert Rucker, the head of our macro and commodities research team, who is going to share his thoughts with us on the topic of mobility. Norbert, so we're seeing more and more electric cars around, and Silicon Valley is dreaming of autonomous vehicles taking to the road. Do you think we're at the start of a new era in mobility?
Yes, we believe we are. And basically, it's not only about the trends of electric cars and self-driving vehicles. There's actually more to that. For example, we have urbanization, and cities have less cars. There's less ownership of cars in cities. For example, if you look at Asia, these Asian megacities, they already are at car ownership levels comparable to the Western world. Or there's also the trend that goes from owning to using. And we have the services like ride-hailing, like bike sharing. They have an important impact because they change our attitude towards the way we consume mobility. So overall, all these trends might in fact develop a self-reinforcing kind of market disruptive impact. That's why we have this such uncontested vision of this future of self-driving cars.
Do you expect that electric cars will be available to the mass market soon?
Yeah, they should become available to the mass market. Of course, electric cars are not the perfect solution for everyone, especially those that regularly drive long distances. They're still going to rely on a combustion engine for the time being. But nevertheless, it also shows that the range anxiety somewhat disappears as soon as you have electric cars that are able to drive more than 300 kilometers. And if you look at the automakers, they all are launching new models over the coming 5 years that exactly offer this kind of convenience at comparably low cost. So we believe that the electric car mass market will develop across different customer segments over time.
And are the batteries going to be an obstacle given their high costs and limited mileage?
We don't think so. It's true that if you look only at the sticker price, electric cars are more expensive than their comparable peers. However, if you start looking at the total cost of ownership, electric cars today are already more affordable. It's because they are very energy efficient, so charging up at home or the charging station, in fact, is less costly, and also they require much less maintenance.
Within mobility, which areas have the greatest potential?
Well, basically, electric cars and self-driving vehicles means there's a lot more technology content in these kind of vehicles. So basically, the technology sector is particularly well positioned to benefit from these long-term trends because there's a lot more electronics that you put into a car. On the other hand, you have the segment of mobility service, which is still a very young business, a business that's rapidly evolving and very dynamic.
And so who do you think will be the losers?
Well, if you look at automakers, they definitely see more threats, more challenges than opportunities. Because electric mobility also means that their playing field has been leveled. There are many new entrants coming exactly from that field that increase the competition overall. And automakers also currently need to invest a lot of money, a lot of capital to keep up with the technology competence.
Are battery metal suppliers and battery manufacturers also an opportunity that investors should consider?
Well, batteries definitely are one of the key growth stories of the future mobility. And if you look at lithium and cobalt, so two of these key ingredients of batteries, they had a stellar performance of the past years with prices basically multiplying. We believe the near-term outlook is less convincing because what we see there for these two metals is a very traditional commodity cycle at work. So you had high prices, which generated investments, and now you have supply catching up to demand, which eventually should lead to a downturn in its commodity cycle and pressure prices. If you look at the battery makers, this business segment for us is also less convincing because it requires very high investments, very high capital needs. It has low margins and there's a very intense competition. So we struggle to see a case where battery makers really generate sustainable cash flows long term, then in the end get distributed to investors.
Do you think that a peak in oil demand is on the horizon? And if so, are energy companies at all attractive to hold in a portfolio?
It's interesting. Investors seem to be quite concerned already about a peak in oil demand. And yes, we see a peak in oil demand probably around somewhere 2035. However, if you look at the energy sector overall, they seem to be quite well diversified. they currently already have very high stakes in the natural gas business or the petrochemicals business. And if you look at these two markets, there the long-term growth outlook seems to be very convincing. So basically it's the shale boom, so this shale revolution coming out of North America, which really creates business opportunities that more than offset the peak oil demand threats. So yes, if you look at today at your portfolio, we think energy companies have their space, especially if you consider the low valuations. And looking ahead, the more imminent risk is really more cyclical. So we are late stage growth outlook. There will become some growth slowdown, and this is the bigger threat to this position than the longer term peak oil demand.
Thank you very much for sharing your insights today, Norbert. And thank you for watching. We look forward to bringing you more market insights very soon. Bye for now.